You need funding. For a business, a project, something that at present exists only as a shape in your head and a set of numbers you have arranged optimistically. You ask Emma. Emma has known you a long time. She trusts you, and she lends you the money. And because you are both sensible people, something gets written down. Call it an IOU, a signed scrap in a drawer, a line in a ledger. It records that you owe Emma a sum, and it records nothing else. We will set interest aside for the moment because interest complicates the picture, and the picture is already stranger than it appears. Some months later, Emma wants to fund something of her own. She goes to Oscar. Oscar is more careful than Emma, and he wants security. Something he can hold, something with recoverable value if the arrangement sours. Emma has no property to charge and no vehicle on finance. What she has is your promise, so she pledges that. The IOU goes to Oscar as collateral, and Oscar lends against it. Look closely at what has just occurred because it is easy to miss, and everything that follows is contained inside it. A promise became a possession. Your obligation, an intention held in your own skull, backed by your willingness and your capacity to earn and nothing else in the physical world, has been converted into an asset on Emma's side of a ledger and then pledged as security to a third party who has never met you. Oscar's loan is secured in the strict sense. He holds a claim over a specific thing. But the specific thing is not a thing. It is you. More precisely, it is the expectation of you. We now have debt backed by debt. 2 links, 1 drawer, no metal anywhere. And if Oscar should need liquidity, he can pledge Emma's note onward to someone else, who may pledge it onward again. And at every stage, the paper accumulates signatures, and the distance between the last lender and the original borrower grows by 1 more degree of abstraction. Nobody in that chain has done anything improper. Each transaction is rational, documented, and enforceable. It is only when you stand back and look at the whole assembly that you notice the load-bearing member at the bottom is a person, and the person is standing on nothing. This is the shape of the modern financial system, executed at a scale that makes the domestic version look quaint. Government bonds are pledged to borrow cash. The cash buys instruments. The instruments are pledged again. The same collateral does several jobs in a day and appears on several balance sheets at once, each holder recording it as an asset with the reasonable confidence that not all of them will reach for it simultaneously. Velocity does the work that substance used to do, and it functions, genuinely, durably functions, for the same reason the Emma arrangement functions, which is that promises kept are indistinguishable from money until the moment one of them is broken. There was once a floor. Before August 1971, the chain terminated somewhere solid. However many hands a claim passed through, however many times it was pledged and repledged, it ultimately gestured toward a quantity of metal sitting in a vault, and that metal did not care about sentiment. Nixon closed the window, and the floor became a promise like all the others. The pyramid did not collapse, it simply lost its base and kept standing, which turns out to be entirely possible provided everyone continues to look forward rather than down. What replaced gold was the sovereign's word, which is to say a claim on the future taxable output of a nation. The chain still ends somewhere. It ends in work not yet performed. Now put interest back in. Without it, the arrangement merely circulates. You owe Emma 100, Emma owes Oscar 100, and if all the promises are honored, the ledgers close cleanly. Introduce interest, and the arithmetic changes character entirely. You owe Emma 110. The 10 does not exist. It has not been created, earned, or produced by anyone. It is a claim on value that is scheduled to appear. Somebody, somewhere, must borrow it into existence so that you can obtain it and hand it over. Every loan issued at interest therefore requires, in aggregate, the issuance of further loans simply to service it. This is why the price of time is more than a valuation convenience. Compounding is the mechanism by which growth stops being an aspiration of the system and becomes a structural requirement of it. An economy running on interest-bearing credit cannot choose stasis. It expands or it defaults, and there is no third setting on the dial. The banks arrived at all this earlier than the rest of us and formalized it. The story we are told in school is the fractional reserve. Emma deposits her money, the bank lends most of it to Oscar, and the arrangement holds so long as Emma does not want all of it back at once. The bank run is the failure mode, the thing the arrangement is designed around. The nightmare that gave us queues, outside branches, and the enduring image of a manager explaining that the money is not in the building. But the institutions got clever, and the constraint moved. It moved from having the money to being believed capable of settling. Once a bank can guarantee that a transaction will clear, that when you press the button, the amount arrives at the other end, and the other end's bank accepts it, the deposit ceases to function as the raw material of the loan. The loan creates the deposit. The bank writes an asset and a liability into existence in the same keystroke, the asset being your obligation and the liability being the balance now sitting in your account, and the two net to nothing at the moment of creation. The popular version of this, that money is conjured on a screen, is a simplification. It is not much of one. Which raises the question the domestic version of the story concealed, and it is the question I keep circling back to. When a bank lends into existence money that did not previously exist, to whom precisely do you owe it? Not to Emma. There is no Emma. No depositor was deprived of anything, no saver went without, no pool of accumulated thrift was drawn down to fund you. The counterparty on the other side of your obligation is not a person with a stake and a grievance and a claim they might one day press. It is time. You owe the future's output, the future's labor, the future's capacity to generate more value than was borrowed against it. The bank is merely the intermediary that priced the transaction and now administers it. And here is the thing about the future as a counterparty. It is the most accommodating creditor ever devised. It does not audit the terms. It does not renegotiate when conditions change, does not refuse a rollover, does not appear at the committee to argue that the assumptions were unrealistic. It cannot decline the obligation, because at the moment the obligation is written, the party who will carry it has no standing, no representation, and in many cases no birth certificate. This is the contract nobody signed in its purest form, executed at the level of the monetary system itself, an obligation binding a party who was never consulted, enforced by a mechanism they had no hand in building. So the arrangement holds, and it holds for a reason worth stating plainly, because it is the honest half of the machinery, and it is the half that gets least attention. Emma borrows. Emma builds something. The something works. Customers arrive, wages are paid, goods leave the premises and do not come back. The note is settled out of what the enterprise produced, and at that moment the money created at the outset acquires a justification it did not possess when it was created. This is credit preceding value and calling it into being, and the sequence matters more than the outcome. The print came first. The value came second and reached backwards to legitimize it. A currency in a fiat system is backed by precisely this and by nothing else. The accumulated weight of promises that were made good, the aggregate of enterprises that produced more than was advanced to them. Every business that succeeds is quietly issuing the backing for money that was already spent. That is how the arrangement is supposed to work, and when it works, it is a genuinely elegant piece of engineering, the only mechanism we have found for letting a society draw on capacity it has yet to develop. Now take the same chain and put a weak link in it. You borrow from Emma. Emma pledges your note to Oscar. Oscar refinances against it further along, and somewhere in that sequence the enterprise fails to produce. No customers, no goods, no output. The value that was supposed to arrive and retroactively pay for the print never arrives at all. What is instructive is what happens next, because the obligations do not evaporate along with the enterprise. Emma still owes Oscar in full. Oscar still owes whoever stands behind him. The failure occurred at the bottom, and the demand for settlement travels upward through every party in the chain regardless, each of whom must now find the money somewhere other than the place it was supposed to come from, and the only place it can be found is another loan. A default that cannot be absorbed is refinanced, which means the response to value that failed to materialize is the creation of further claims against value that has yet to materialize. The whole is filled with more of the substance that made it. Scale that to a system, and you have the mechanism by which a fortress of paper is built. Every story rests on the story beneath it, and the whole structure is sound for exactly as long as productive output keeps pace with the claims written against it. When output slows, when the economy stops generating enough real value to justify the money already issued against its future, nothing dramatic announces itself. The claims simply sit there, unchanged in nominal terms, resting on a smaller base than they were priced for. The lease drawn on the future does not lapse when the future underperforms. It tightens. More of the present must be surrendered to service the same obligation, which leaves less capacity to produce with, which makes the next payment harder still. The mechanism is entirely indifferent to which half of this it is participating in. It processes a loan against a factory and a loan against a share buyback with identical machinery and identical enthusiasm. Both create claims on the future, only one creates the capacity to meet them. Because the party being drawn against cannot object, the difference between the two stays invisible at the point of issuance and becomes legible decades later when a generation arrives to find the productive capacity already pledged and the interest already accruing. That is the deeper reading of borrowed time. What gets extended is the assumption that somebody downstream will be good for it, and the maturity date is merely where that assumption is written down. Whether the fortress falls is the question everybody asks, and it is the wrong one. A structure of this kind rarely comes down in an afternoon because nobody standing inside it has any interest in testing which link is weak. The chain is held together as much by mutual reluctance as by solvency. Extend the term, restate the collateral, keep the loss theoretical and the paper performing. What happens instead is quieter and considerably harder to prosecute. The claims exceed the output, the claims are honored anyway, and the shortfall is paid by the unit of account itself, which buys progressively less of the real world each year. The fortress does not fall, it settles, and the sound it makes as it settles is the price of everything going up while the wages of the people underneath it do not. Emma's IOU sitting in Oscar's drawer is only worth something because you intend to work. That intention is the entire asset. Multiply that drawer by every ledger in every institution in every jurisdiction, and you have a financial system whose foundation is a collective, unwritten, unratified assumption that tomorrow will be more productive than today, and which, having made the assumption, proceeds to spend against it in advance. The future is not consulted, and it does not consent. It only ever arrives, and finds out what it agreed to.